All right, everyone. Today I have an awesome opportunity to interview one of my top commercial agents in my office. We're going to talk about multi-residential properties and how we use it as a hedge against inflation. All right, welcome back to another episode of Sold As Is. Today I'm here with my good buddy, Mike Tootikian, Keller Williams agent, commercial specialty. And Mike, why don't you introduce yourself? Tell them a little bit about how long you've been in the real estate industry.
Sure. I've been in the business since the mid-1980s. So I started as a young man and started selling apartment buildings, kind of slowly learned the business and built everything up, again, one step at a time. It's a great career.
I love it. And you and I have had a chance to work together for probably over the last 10 years. So
yeah, Tom and I go back since 2012, and he's one of the best. I'm happy to be associated with him.
Thank you, Mike. I appreciate that. So, our podcast that Matt and I have been kind of sharing with everybody is really looking at what's going on in the market right now and nationally. Matt and I were talking about, interest rates being high, gas prices being high, and obviously inflation. And as we zoomed locally down into our markets, we're realizing that, we have the same problem. And how is it affecting the real estate industry? How is it affecting everybody here in Los Angeles? And one of the things that Matt and I kind of found out was really real estate is a great vehicle for people to be investing in right now more than ever in the shifting market as a great hedge against inflation. We're finding that as inflation grows and prices go up, so do rents.
Yes.
So, that's kind of why I wanted to have you on, because your specialty in multi-residential properties, I think, could help our listeners and our viewers get some great information on that.
Sure. Okay. And be happy to.
Yeah.
Again, briefly, the way the real estate market is with the apartment market, it's really been a great career. It's been a great business up until we hit the pandemic.
Okay.
Once the pandemic hit in March of 2020, everything froze.
So you saw a dip for a bit.
Yes.
Interesting.
A dip with rents, a dip because of people stopped going to work.
Yeah.
And it was just and investors, seasoned investors that buy and own and manage apartment buildings, stopped because they were just nervous.
Yeah.
Eventually, we made it through. All of a sudden, rents started increasing again. Values have continued to rise. Rents have increased at the same time.
Interesting.
So I still say that overall in Los Angeles, this is a great time to still invest in multifamily. And to jump on what Tom had mentioned, a lot of the seasoned clients are refinancing right now, despite the increase in interest rates, and they're starting to buy apartment buildings again with the money they have.
Yeah, good. So we're kind of on the same page as far as what you're seeing people who already own real estate or investment properties doing, and kind of my niche of my clients who maybe own some single family residence. Because what we're finding is people have these single family homes and they've got this trapped equity in there, and we're kind of been encouraging them to kind of pull that equity out and to invest into some apartment buildings or 2-unit, 3-units, so that they can have a good hedge against inflation. You made me think of something too, was, we've had a couple of real estate agents in our office actually leave California because of that pandemic issue of their fear of rents not being paid, and they didn't want to invest anymore. So they went out to Texas and they went out to these other areas. And now that the market's shifting, I'm hearing that the values are dropping over there. I think Austin's got a huge uptick in the amount of inventory that's coming out there. So surprise, LA still holding strong and stuff like that.
The thing with apartment business, with owning and managing an apartment building, is it is somewhat management intensive. It's something you need to pay attention to. And I could only tell you from my personal experience and from my clients, owning an apartment building it's more like a marathon than it is a sprint.
Interesting.
It's, in other words, when you're buying an apartment building, you're really not getting the first year a huge return on your investment.
Okay.
And that's the reality of it.
Good to know.
But what you're doing is you're buying based on rents eventually going up, which they still have and they've done, and we can have studies to show everybody how rents have increased, but also you get appreciation here. Now, Tom had mentioned something about the Texas or an out-of-state market. An investor will do better on their cash-on-cash return if they buy a building that's out of state.
Okay.
But in terms of the appreciation, they don't get that.
Interesting.
So it depends on what the investor's goal is going to be. Are you first of all, looking at a long-term investment?
Okay.
Are you looking at a short-term investment? Are you looking at immediate cash-on-cash return? Or are you looking more for appreciation?
Gotcha.
Those are things that Tom and I can educate our clients on their goals.
Gotcha. So, Mike, what do you see the majority of people that are buying buildings? Are they appreciation oriented, or are they the cash on cash guys? Or who's winning the race? Or is there a difference in race?
No, it's great. You have a certain clientele that will buy a cash on cash.
Okay.
But in doing so, then there's an old adage that we've all learned in location, right?
Yeah.
So in a nutshell, if you're buying a better location, you're getting, like say in the San Fernando Valley, if you're buying a Sherman Oaks, a Studio City, a West Toluca Lake, or good areas of Hollywood, you're getting less cash on cash,
right,
but you're getting better appreciation.
Gotcha.
Other areas you can go to where they're not as affluent, but
right,
still densely populated, you're getting a better cash on cash return.
Gotcha.
Again, they're a little bit more management intensive, but at the same time, it really depends on the individual's goals. So some people like appreciation, some people like the cash on cash.
So in your experience, Mike, would you say if I was, or one of our clients came to us and said, hey, this is all I can afford right now, maybe we start them off in an area of Van Nuys or Palmdale or some of these other areas just to get them in the game,
yes,
so that essentially they can start moving up? Because I think what I'm hearing is appreciation is probably going to be the end result of where the big money's at.
Yes, if you hold on to the building long term and you're doing well with the building, well meaning if you're managing it properly,
right,
you're going to do fine.
Gotcha.
Just again, it boils down to it's more like a marathon than it is a sprint. You have to be patient. You have to buy right. You have to get educated with the rental market, what rents are going for in that particular area,
right,
what values are. There's a lot of homework that needs to be done, but at the same time, it's a joy. It's simple to do, and the process is great. It just depends on what you want to do on your goal. But what you said was a good area of Van Nuys, great area to start with.
Gotcha. What do you mean by managing it right?
Okay, managing it right that's a great question,
Yeah,
Tom.
like
basically, you have to
how do you manage it wrong?
Simple. You manage it wrong by a lot of people. They think that, okay, I have enough capital, I'm going to buy an apartment building.
Right.
They buy it, they go through the process, they close the escrow, and they just think they're going to collect the rents.
Okay.
You have to be proactive. Proactive meaning you need to go visit your property. You don't necessarily have to talk to their tenants,
right,
but if you don't pay attention to the property, the day-to-day operations of the building, because you're going to have vendors out there too. Remember, in an apartment building, you're collecting rents,
right,
but also there's expenses. You have property tax, you have insurance, you have trash pickup, you have utilities, and if the property is not being maintained properly, which is the landlord's responsibility.
So when you mean maintained, we're talking about, sorry about that. We're talking about painting. We're talking about roofing.
Yes,
we're talking
plumbing,
about upgrades
electrical,
and stuff like that. So you can find that not maintaining a property, meaning not taking care of and making sure it's in good condition. Landscape.
Simple things
like that. It can become an eyesore or maybe a blemish to where nobody wants to pick up that building in the future because it's been so much deferred maintenance has been to it that nobody wants it.
Plus, it will also hurt your rental value.
Okay.
Obviously, the nicer your apartment building is, both aesthetically on the outside and also in the interior, you're going to get a better quality tenant. You're going to get the highest rent possible, which is basically what the landlord's goal is.
Right.
Because the better the rent, the better the income. You're going to get a positive cash flow,
right,
but also that appreciation comes into effect.
Makes sense.
So you do have to maintain it. There are certain owners that we've seen. I've had stockbrokers, I've had doctors, lawyers, very affluent individuals, buy apartment buildings.
Yeah.
And they end up coming back and saying, Michael, I don't know why I bought this, because it's a nightmare for me. And then and I said, well, why is there a nightmare? And they say, well, because the tenants are complaining, toilets are leaking, and this and that. And I said, well, are you paying attention to it? Do you have a maintenance crew?
Right.
Do you have people that are going there on a daily basis, making sure the building is running okay?
It's so funny, Mike, that you say that, because in our earlier podcast, we were hearing a lot of that feedback from a lot of these seasoned investors. They don't want to they get out of the ownership of multi-res because of those headaches. And one of the things that we wanted to focus on, and I'm sure you do, is setting these clients up with good property management companies, management companies that have servicers for vendors that are going to come and take care of those things like that, right?
Yeah, we have, look, part of our brokerage is to help the client.
Gotcha.
So if a client is really serious about wanting to invest in multifamily, we walk the client through every facet of it. From the time looking at properties, looking at locations, looking at their down payment, looking what their goals are, to also, after they purchase the property, how they're going to go ahead and maintain it.
Love it.
So we're there to assist the client that way.
What kind of opportunities are you seeing right now? It's the middle of 2022. Interest rates are up. What are people actively out buying right now?
People nowadays are so nervous. I mean, everybody is, with just the overall cost of living.
Right.
You go to the supermarket now, you go to buy some food, everything's expensive. Look at gas. I mean, look, we're all dealing with it.
Yeah.
It's affected every demographic.
Absolutely.
But in doing so, people still need a place to live.
True.
Apartment buildings are still a great investment. The thing is, with the interest rates right now, you just have to look at what the current income is on the building to what the interest rate is, and will the building make sense? So in a nutshell, I have a lot of seasoned clients still actively looking every day. Michael, find me a building we want to buy.
Has their parameter changed? Like, are they being more lenient in their numbers? Meaning, hey, Tom, before I needed to make I don't know, $10,000 a month, but right now I'm happy to make $5,000 a month.
Great question. Yes, the investor has done that, but also at the same time, the investor, which we used to be paying a higher value when they see a building on the market, is right now saying, as much as I like this apartment building, I could only pay this amount.
Okay.
Because at a certain point, it will not make sense to that investor.
Got you. And some of these buildings, Mike, they qualify on their own, right? So if I'm an investor and I've got some equity, I can pull it out. And a lot of these loans, don't the buildings qualify? Meaning the rents that come in, can you be used to offset the payment on that?
Oh yeah, absolutely. But the thing you have to understand, when you're buying an apartment building, unlike a single family home, you have two ways of lending.
Okay.
So you have basically what they call residential lending, which is basically 1 to 4 units.
Okay.
So even though you're buying a multifamily, a 1 to 4 unit, you're getting a 30-year fixed rate loan. You can get in if you qualify with 20% down payment.
Right.
You might not get a positive cash flow, but you're buying with a less down payment. When you
So real quick, in that mindset, you're looking at appreciation then.
Absolutely.
You're not necessarily looking at cash flow. You're more looking at the future of saying, hey, I'm going to stash this cash, and I know that I'm putting it in a quality property. I'm putting it in a 7 Series BMW,
yes,
and not a 3 Series BMW where it's going to hold its value a
right.
longer.
Or you're buying a great stock.
Okay.
You're buying something like a Nike, or something that's always appreciating in value.
Got you.
Down the line. Now, when you're buying it, and it gets a little complicated, but when you're buying a 2 to 4 unit, you're buying, I mean, you can buy and be an owner occupied.
Right.
You can live in one unit, which is a great advantage.
Right.
And then rent the other ones out. But if you want to go a little bit larger, 5 units or more, the way the lenders lend is they lend based on what they call a debt coverage ratio.
Okay.
Which in regular terms, it's taking the gross income, eliminating your expenses,
okay,
and figuring out what the debt, what your loan is going to be when you buy an apartment building, and what is left on the return on the investment. So the lender will look at the strength of the buyer, but they also look at the income and the expenses historically of the current apartment building.
Gotcha.
So in the long story short, if you're buying over 5 units, be prepared to put minimum on a down payment, regardless of the purchase price, 45% down payment.
Wow. Okay, good to know. You know, I hear a lot of investment people talk about cap rates. What share with everybody what a
Sure.
cap rate is?
Great question, Tom. Cap rate is a value factor on an indicator for an apartment building.
Okay.
The cap rate basically is what is going to be the percentage, your return on your investment, if you were to buy this investment as an all-cash property.
So let's just have a scenario to keep it real simple. I bought a building for $100,000. I had to put 45% down, which would be $45,000.
Sure.
The cap rate would be the return on my $45,000.
Yes.
Would be, you're saying on average I'd be making 7% on that $45,000?
There are no 7% cap rates in Los Angeles.
God, well,
or in
what would be a
California.
cap rate, would you say?
A cap rate would be right now anywhere from about, we're actually looking from about 3 to 4.5%, depending on location. That's your cap rate. Cap rate, again, it's your net operating income after, that's what you're basically receiving after all your expenses, including your loan.
So
Eliminating the debt.
To keep it kind of simple, then one more time is, let's say I invested $100,000 in this building, and my cap is 3%. That means I would be making 3% a year on this $100,000.
Yes, that would be your return on your investment.
That would be about what, $3,000 a year return on my $100,000 investment.
Basically, yes, that's what it would be.
So it may not necessarily be like, oh my gosh, I'm so excited to part with $100,000 to make $3,000 a year on that money. However, now you get to factor in depreciation.
Absolutely.
And appreciation.
Yes, you have tax advantages.
And the tax shelter that you get from that. So I think that's where people are not really looking at the big picture of owning real estate. They only look at, like you said, the cash on cash, but they're not seeing the other aspects of that real estate.
Yeah, Tom, you hit it right on. In the very beginning, your first year or two, you're not going to get the best cash return, but you are going to get a return. But the thing is, you're owning a great asset that's only going to get better.
Right.
It's going to start here, and it's only going to grow,
Right.
and it's only going to get better. So many of my clients, all they do is buy and own and manage apartment buildings.
Right.
And what they've done is, going back to what you said in the beginning, they've taken their money when they've owned either a single family home or a certain property, they've refinanced. They pulled that cash out, they've taken that money, and they've started investing. And if you just do it methodically and you have the right team and you go step by step, they're still looking to buy. I don't have a shortage of buyers.
Yeah.
We need more owners right now that want to sell.
It just, it made me think of something right now of kind of like, this is wealth for the future. This is for your future generations of your lineage sometimes that, hey, I bought 4 buildings, I handed them down to my son, now he bought 4 buildings, and now we have 8 buildings in our portfolio. And, this is like long-term generational wealth that people are
many of my
building.
clients are exactly what you just mentioned.
Right.
They start out that way. But to also segue into that, I've had people that had their own businesses. I've had people that were in the food business, or they just had their own businesses in the beginning that also took their investments and started buying apartment buildings. And they ended up leaving the business that they owned before and becoming full-time landlords.
Yeah.
and they build up their own clientele, their own vendors, their own management.
Right.
They have a team to do it. So yeah, there's so many opportunities.
That's just like us in real estate. You know, we always talk about using real estate as a vehicle to buy assets, to buy other properties, so that eventually we're out of the real estate market as salespeople and we're now becoming investors. So it's just them doing the same thing that kind of we do, where they were using one industry to buy real estate, and then eventually they're not even in real estate or in that other business anymore. That makes a lot of sense.
I've been fortunate enough where I've been in the business long enough where I've seen a lot of different markets.
Right.
When I first started in real estate, you realize interest rates were, guys, you're going to freak out at this. No, I wish. When I first started, they were like at 18, 19%.
Yeah.
When I first got my license and first started selling apartment buildings, but we didn't know any better.
Yeah.
So we did well. You just adapt. But I've seen markets change.
Yeah.
And at the end of the day, we are very fortunate. We're in Los Angeles.
Yeah.
One of the best cities.
Movie capital of the world.
Absolutely. Entertainment capital, sports. You have so many things going. You have jobs still available over here. So even with the economic ups and downs that we all go through, it's still the best place to be owning and managing real estate. It's still that's why it keeps me in the business. I'm still excited after all these years of doing deals, because it's very challenging, but it's exciting. It's a lot of fun, and watching your clients do really well, it's just great. You just have to educate them.
Yeah, I think it's in my mind right now of just looking out at everybody and saying, look, getting that equity out of that house and investing in your first building. I mean, maybe it might be scary. You might be not getting that return, but if you could just take a bird's eye view and look at your future self down the road, where you've got 2 or 3 buildings or 10 buildings down the road, you're going to look back and say, man, it all started when Tom sold me that building, or when Mike sold me that first building. And yeah, I only put $100 in my pocket back then, but you have to start somewhere.
Absolutely. And you can't be afraid to fail.
Yeah.
That's in life.
Yeah.
We have to take chances.
Yeah.
But what you do is you learn to take calculated risks.
Yeah.
And that's what you do. You learn to educate yourself first. Find out what your goals are. Tom, I think you hit it really great. People that have long-term equity on their homes, and if they're okay cash-wise, take that money now, use it to buy something else. You can buy, if you want, other single-family homes.
Sure.
Use them as rentals. You can go in and buying multifamily units.
Yeah.
There's opportunities out there, but you just have to look into them.
And especially with this Airbnb stuff that's out there right now. I mean, some of these single family homes, I know I've got some people out in Palm Springs where they've been buying these properties. They're spending like $900,000 now to be in Palm Springs, but they're collecting like 3 times the rent that they would be collecting had they just had it rented month to month.
Absolutely.
Or on a year lease.
Right.
They're collecting
Sure.
$6,000, $8,000, $10,000 a month because people are wanting to go out there. So yeah, maybe it's to pick up an investment property like that, but let's get this equity to work for you guys, so that people can start building this wealth.
Most of my clients that own apartment buildings, they look back on it and they're really happy that they're, even with some of the obstacles that they've had to face, they're happy that they've gotten into this business and they're doing it. And they're constantly looking for more properties.
Right. You know, one of the things we talked about in our last podcast was, I think when you acquire enough property as well, you can leverage some of this expenses of vacancies, of maintenance, off on some of these other properties.
Of course.
Some of these other rents are coming in and you're just taking some of the profit from there and helping this other building out. So in the beginning, it might be a little bit out of pocket, but as you start acquiring inventory and you're able to leverage that stuff, am I right on that?
My clients are doing that all the time.
All the time.
The ones that own multiple properties do it all the time.
Good. I want to start wrapping up because I know you and I can sit here and talk for hours about this stuff, but what are some of the challenges that you see with homeowners?
Well,
build people that have buildings, and you're asking them, hey, you're ready to sell your 5-unit, your 8-unit. What are some of their pushbacks that they're having?
the first thing is, if I sell, this is I'm talking to an owner, who's owned an apartment building a long time. I ask him, I go, what are your plans with the apartment building? Would you like to sell? Michael, I would love to sell this building right now. I'm not in the position where I want to buy another building.
Okay.
Sometimes they don't want to exchange into another one, so they're going to be faced with a capital gains tax. So some of them just say, look, I don't want to sell because IRS is going to take a huge amount of capital gains.
Gotcha.
Some of them don't want to buy anymore.
Gotcha.
But then at the same time, they do realize that they've had such good appreciation. So, one of our clients, we just sold them a 10-unit apartment building. They've owned it since 1986.
Yeah.
They managed it themselves, self-managed, and he ended up paying the tax, but he was happy. He was done.
Served his purpose.
Yeah, so even though he paid the tax, because of all the appreciation, he was thrilled.
He could pay Uncle Sam and still walk out with some money in his
He's
pocket,
now enjoying his life.
Happy.
He's enjoying his life.
I love it.
But there are other clients out there sometimes when they own an apartment building and they have very little or no debt, they've started doing installment sales, which we can get into later. Basically, a certain down payment a buyer would take, and they would become a lender.
Oh, okay.
And they would carry back the note.
Got you. They become the bank.
They become the bank.
Interesting.
So that's another avenue.
Gotcha.
But also some of the obstacles right now, of course, since the pandemic, in LA City, there are certain apartment buildings that unfortunately you can't raise rents right now.
There's a moratorium.
There's a moratorium on that. There's been a moratorium on evictions.
Yep.
So it's really been challenging for a lot of the landlords.
Yeah.
But the landlords have been through it a long time. They know how to adapt.
Yeah.
Like anything else, when it comes to change, you learn how to adapt. You learn how to adjust.
Yeah.
But then you keep going.
Yeah.
And they figure that there's going to be light at the end of the tunnel. And again, it goes back to the fact that as much as we have some obstacles right now, Los Angeles is still one of the best cities.
Amen.
And as long as we have jobs coming in, people need a place to live, we've still seen rents go up.
Yeah. I know that I was listening to an economist, and he was saying that one of the things that the pandemic has taught people is housing is really important, having a place to live. And the amount of delinquent rents is really low. Even though this moratorium's in place, there's still a lot of people who are paying their rent because they know they need to have a place to live.
Well, sure.
So I know that, you hear a lot of people who want to get into real estate. They're, I don't know, this moratorium, what if I buy a building and then nobody wants to pay me? I don't think that's really the concept, right, Mike?
Most of the tenants are paying rents.
Yeah, very few.
And the few that are not, at the end, they're going to hurt themselves.
Right.
Because it does go back and hurt. It's going to ding their credit so much.
Yeah.
So for the short term that you get a tenant or two that refuses to pay their rent,
right,
they're going to hurt themselves.
Yeah.
Now, if they're really financially in the bind due to COVID, there's always been ways to go around where there's government assistance programs to help them. Rent relief programs, they've done that. But for the majority, most of the tenants are paying rent because, again, if they leave right now and if they go to another apartment building in Los Angeles, whatever they're paying right now is going to be a heck of a lot more later on.
Right. Hey, Mike, I definitely want to continue this conversation with us going on for some future episodes and stuff like that. But for right now, I want to make sure that we drop a link in down below in this video so that any of our friends or family or colleagues are out there watching this, they want to know how to get a hold of you to start looking at some of these investment opportunities out here, that they can do that. And let's you and I pick this back up again real soon, yeah?
I love it, Tom. Anytime.
Awesome, Mike.
My pleasure.
All right, good to see you. Good
you
talking
too.
to you, Mike.
Thank you so much.
All right, talk to you in a bit. All right, guys, talk to you in a bit.
Thank you.